Well, hello, everybody. I'm just pulling up a chart for everybody to see. This is Blair Nightingale coming at you here from East Texas. It is Market Monday. Tonight, Wall Street banks forecasting a recession. We're going to talk about that tonight. I want to start with this. In the Tradeway community, when I was very first a student, I heard some of the testimonies of some of the coaches, why they became traders. A lot of people in the Tradeway community have never traded before, right? A lot of you guys out there, you've done maybe a little bit of trading. Maybe you've done a little bit of investing, but not trading. Maybe you're curious about trading. You've heard about it. Wherever you're at in the journey, Tradeway has a lot of people who are just starting out. These coaches would give their testimonies. And let me tell you, a lot of them would say something that goes like this. I had a retirement account. I had been working and investing into that retirement for decades. And then 2001 hit, dot-com bubble, and the economy collapsed, right? It collapsed into a recession. We've talked about this on here before. Markets, economies, nations, right? This is true of America. It moves in cycles. It moves in cycles, okay? Recessions, while we should do what we can to avoid them, we're not trying to trigger them. Sooner or later, they do happen. The economy expands, but it also contracts. It resets. Now, mismanagement can speed that process up. We'll talk about that. But for you and I, something like 2000 is something that I heard these coaches talk about, and they said, you know what, I lost 10, 20, 30, in some cases, 40+% of their retirement in that crash. The same thing was true for 2008, less than a decade later, right? Less than a decade later, we saw 2008, the Great Recession, where we saw the housing market collapse. And again, people lost double-digit returns in their retirement accounts. Now, obviously, this affected a lot more financially for Americans and American families than just retirement accounts. Here on Market Monday, we focus on stocks, stock trading. But this is true on a bigger picture, a bigger level than just on Wall Street, right? It hit Main Street pretty hard. Now, here's what I want to say. In a lot of cases, these individuals said, you know what? I need to take the power into my own hands. I am not going to have somebody else who doesn't care about my money as much as I care about my money, managing my money, because they're not doing a good enough job anyway. Now, I'm not demonizing analysts, financial advisors, right? I am a licensed advisor, right? I'm not demonizing that. I'm saying I think it's our job in this industry to tell folks out there the same way I was told, hey, you can learn a lot. You can learn a lot. By the way, Warren Buffett has said this. A lot of Wall Street wizards have said this, that people who learn some basic investing tools could do it themselves. They could do it themselves. And these individuals who paid professionals to manage their money saw massive losses in recessions. In 2020, I knew an individual when I was living in Southern California whose brother was a financial advisor. And I know in the 2020 crash, right, in COVID, unprecedented for sure, right? We shut the whole economy down. It crashed. That individual's brother was losing sleep. He wasn't sleeping at night. Why? Because in this particular case, they're not equipped with what do I do in the case of a recession, and my client's money is at risk. My client's money is at risk. Let me submit this to you. When you buy mutual funds on Wall Street, they accept your money, you pay them a management fee, you assume all the risk, and they are able to take the money that they have custody over, and the fees and a lot of activity that happens on the back end, by the way, in terms of fees and costs of managing a fund. They make a lot of money, pass on a portion of the returns to you and I, but you know what they pass 100% on? You know what they pass 100% of to us? The risk. 100% of the risk goes to you and me. I'm telling you what, I'm going to say this tonight. I hope you share this recording. I hope people out there hear this. The United States will eventually, I'm not predicting when it is tonight, by the way, but I will tell you some factors that are at work, some things that you can watch for. People go through recessions in this country, and a lot of times it's a surprise. It's a total surprise. And then the blame game happens. And part of that, there should be accountability. We should assess what happened. Why is it happening? How do we fix that? Okay, we're in agreement on that. But I would say for me as well as you, the reality of financial life is that there are going to be times, back to the story of Joseph, 7 fat cows, 7 skinny cows, right? There are times of abundance and there are times of recession. This does happen. And I'm telling you, it will happen again. It will happen again. You and I can be prepared instead of being taken off guard, taken by surprise. We should not be taken by surprise. I'm not saying that I want recessions, by the way. I don't want that. I simply know it's a reality. And that means I come to a place where I am now positioned to respond to it ahead of time instead of react to it in the time that it happens and triggers. And of course, a recession on average is going to last about 6 to 8 months. Some have been shorter, some have been longer. But we've got some unique things going on here that could make this recession particularly nasty, right? And it is a good thing for us to talk about and understand, how do I protect what I have and prepare for growth? How do I protect what I have and how do I prepare for growth? That's what we want to talk about, okay? Over the past 75 years, okay? This is data-driven now. Over the past 75 years, every single time inflation has exceeded inflation. What's inflation? When the prices that you and I pay for everyday things is inflating. It's going up. Every time inflation has exceeded 4% and unemployment has gone below 5%, the U.S. economy has gone into a recession within 2 years. Okay? This is where inflation right now is at over 8%. Over 8%. Deutsche Bank, we talk about the big boys here at Tradeway. What are the big boys? When we trade in the markets, we want to learn. This is what we teach you in our system, tradeway.com. Step 1, start your journey. I'll be teaching one in just 2 weeks' time. I'll talk about that more later, but you can go to tradeway.com, sign up for Step 1, start your journey. I'll be teaching that with Mr. Dave Huber in 2 weeks' time. But in that course, we talk about the big boys. That's the big money on Wall Street. It's not you and me. It's not the real retail traders. It's not you and me. That's small money in a big ocean. The big sharks are the Wall Street banks, the hedge funds, right? The mutual funds. Particularly of these Wall Street banks, some of them are starting to forecast a recession. The first of those is a bank that goes by the name Deutsche Bank. This is one of the big investment banks on Wall Street. They see a recession coming by the end of 2023. Why? Because inflation is worse than expected. I will say this, not trying to toot my horn. I promise there's other coaches here at Tradeway and people in this industry who have said this very thing. But you know what the news told us for a long time, particularly 2020, 2021, that the Fed says that inflation is transitory. Inflation is transitory. We kept hearing that over and over. Inflation is transitory. Inflation is transitory. What's the problem with inflation? Inflation is inflating prices, but our wages and our earnings stay the same. So even though Our dollar, in one sense, is still worth the same. It doesn't translate the same because everything we're buying costs more. Now, if our wage growth, if our earnings matched perfectly with the rising of prices, we wouldn't have inflation. But it doesn't work that way. It doesn't work that way unless my money is working for me. Unless I'm making money with my money is falling behind as prices are increasing. The Fed said, no, don't worry about that. It's transitory. It's passing through. We're just seeing it because of COVID. We've just got some shock waves because of COVID. And you know what? They expected us to believe that because most people don't understand. Most people don't understand. But when you print trillions and trillions of dollars and pass it on to taxpayers and buy trillions and trillions of assets and just spend. They gave you and I, what, $1,200? For a year and a half of a shattered economy, we got $1,200. And they said, there you go. That'll get you through. And guess what? That was $1,200 of your own money. That was your money. They just gave us back our taxes and called it a payout, right? This is how this works. And what it has done is it has triggered massive inflation, the devaluation of our currency. It's destabilized the economy, no doubt. COVID was a bear for sure. COVID affected a lot of things negatively. That is a part of it. By the way, they say, I'm hearing it, the talking heads on the news talk about this being a result of Ukraine. In the United States, I'm just going to tell you boldly today, it is not an effect of the war in Ukraine. The war in Ukraine is destabilizing some things in Europe. There are concerns with natural gas and Russia. But as far as us, that is not the immediate concern. It is gross mismanagement. Gross mismanagement. We're seeing inflation, and that is driving concerns. Now, what's happening here is that inflation is going up. Now, one of the things that the government does to control inflation so that you and I don't see it spiral out of control. Now, it's already getting there, right? It's at a 40-year high. Those of you who remember the late 1970s, early 1980s, we're at those levels. Now, we're not at all-time highs, but we're at 40-year highs. They are trying to aggressively get that under control. So for you and I as consumers, what's happening is interest rates are going up. This Wednesday, I believe at 1 p.m., in fact, it is 1 p.m. Central Standard Time, the Fed will release their minutes, the decisions, the news that they have come up with in their meeting this week. They get together, the chairs of the federal banks, and they will decide, what are we going to raise interest rates to? Everyone expects them to raise interest rates. Everyone expects them to not only raise interest rates this week, but multiple more times the rest of 2022. Now, what they are trying to do is decrease demand in our economy and cool inflation. We don't need to understand all the economics behind it. What we need to understand is that interest rates go up, and that gets passed on. That gets passed on credit cards, right? Loans of different kinds, home loans, car loans. It's going to make borrowing money more expensive. Consider the fact that home prices in most maybe, I'm not a real estate expert, but you don't have to be an expert to see that real estate prices in the United States are at record highs. Well, with homes at record highs, I live just outside of the Dallas area. Trying to get into a house here with the kind of bidding wars that come up over any property that's put on the market, now we're going to introduce the fact that you're going to have to pay higher interest, right? It was at near 0% levels, very low, very low. It's up to near 5%, and it's going higher. So not only are they paying premium on a home, but you're also paying a lot higher on a loan, right? Credit cards, car loans, not to mention the fact that cars, the prices of cars, whether it be rental cars, new cars, used cars in particular, those prices have exploded. People are paying more. Okay, but not everybody's making more. all of these factors coming together mean that you and I are facing headwinds. I don't like to predict it's going to happen at this time, but I am going to show you some of the charts from the markets that have had really wild days these last few trading sessions. The NASDAQ, which is primarily representative of the tech sector, is already in a bear market. It's already in a bear market. At one point today, the S&P 500 was down 14% from its high. 14%. I think it has a lot further to go. Now, it's going to move up and down. It's going to bounce. I'm not going to predict that it's going to happen at X date. I'm going to prepare. I'm going to prepare for the future. I don't know when exactly it's going to happen, but I like the wisdom of this scripture when I think about economic cycles. Jesus said, you guys, you don't know the exact date. You don't know the date. It's not for you to know the date, but the times and seasons. He says elsewhere, you can discern the times and the seasons. This isn't speculation that I'm teaching on tonight, okay? The fundamental factors of our economy and those who study them very, very closely are forecasting. Now, just because they forecast a recession doesn't mean it's guaranteed, okay? It doesn't mean it's guaranteed, but we ought to prepare. And if we're not aware, we don't prepare. And if we prepare, then we don't have to have the experience like some of my friends had in 2000 and 2008. Now, I'm also not saying we need to panic. I'm not panicking because I know that for me, because of the skill sets I've learned, recessions, which includes 2020, by the way, can be a tremendous opportunity for investors. Tremendous opportunity for investors. Now, I'll say one more time. This doesn't mean that I want recessions. It doesn't mean that I want people to go into economic hardship. I don't want that. But I know that recessions are a reality. And in life, you and I can choose to be equipped to walk through things that we don't have control over so that we can thrive in them instead of survive in them. Recessions are one of those things. And even though I don't know exactly when that's going to happen, I don't need to. I can know some of the things. I'm going to bring up my chart here. I can know some of the things that are necessary to thrive in those environments. But quickly, let me show you charts here. I'm going to pull this up. There you can see charts. Here's the high back here, guys. Let me go ahead and get rid of this tab. Back here is the high, okay? That's about 4,800, okay? We got pretty close, not quite, to 4,000. You're looking at the S&P right here, to 4,000. Now, if the high is 4,800 and you're getting down to about 4,000, it's a pretty big drop. And consider that while this one here was a bit of a downtrend, right? We moved down, up, down, pretty big rip. Higher is how I would say that. We've collapsed back down to these lows and actually broke them today. Now, today was a pretty wild session. The market is definitely in transition. If you guys have been out there and you've been watching it all, you've seen some pretty big moves down. The NASDAQ on Friday had its worst, I believe it's the worst month since 2008. I'm going to go to the NASDAQ right now. Go to the NASDAQ 100. Okay. This guy moving from 16,500 to about 13,000 level, okay? Taking a pretty massive hit. And a lot of that just in this last month. You can see, like I said, it tried to recover, but that acceleration was there on the downside. Multiple 4% drops last week, okay? There's something in the market when market makers, those who basically grease the wheels for those of you that aren't active traders. Sometimes people will ask me, well, how do you know you can buy and sell the stocks, Blair? What if somebody isn't there actively buying and selling the stocks? Just so you know, this is what's so great about the stock trading business. There's always a buyer and a seller for the companies that we trade because they're highly traded companies, and we know that there is something called market makers. What does a market maker do? They make a market. I go and I buy a stock. Let's say I want to buy, I'm picking a stock. Amazon had a massive day down after losing money. Surprisingly, reporting earnings, losing money on Friday, dropping significantly. Why don't I just pull that up on the chart just so y'all can see it? Amazon. Amazon. Come on, it's Amazon. Amazon always makes money, doesn't it? Oof. Took a huge drop on Friday. A little bit of a recovery late day today, but still down significantly. They are always buying and selling. I'm not doing it with Amazon. I'm doing it with Wall Street. There's somebody called a market maker, market makers. They buy and sell. They fill orders for me when I'm buying, when I'm selling. Our friend Josh is on here in the comments. I'm going to pop this up. He knows, right? Josh is an active trader in our program. He knows he can go in and he can buy and sell what he wants to buy and sell because there's these market makers. On Friday, the market maker expected move, which is a really cool thing we use in options, where these really uber smart people on Wall Street attach to an options expiration what the expected move is for that day. The Friday expiration, meaning at the end of the day, Friday, that options contract would expire and would no longer exist. In the morning, they said the expected move by the end of today is plus or minus. It could go either way, but our uber smart math says we anticipate a move of 43 points plus or minus by the end of the day. Wouldn't it be cool to know how to look at market maker expected move and think, how could I use that in my trading? It's a very, very useful tool for options traders. Market maker expected move, standard deviation. They sound intimidating only because they're new for most of us. But they're actually not that complicated, and they're very, very useful. That said, the move was not 43 points on Friday. It was 155 down. 155 points down. So very volatile, very weak. Did see a little bit of buying. We saw a swing to the upside at the end of the day today. I already told the students in our program, you may see an up day, you may see two. I'm not convinced by that. Bear markets have big up days. Just like bull markets sometimes have big down days. Okay? Overall sentiment, negative. On the chart and in the news, those economic forecasts, it's not wind in the sails right now, guys. It's wind against them. Okay? It's wind against them. There are headwinds, and that is why Deutsche Bank is saying, yeah, we forecast a recession. Right? And I would guess, and this is my opinion, we're going to see more and more Wall Street banks like Domino's going, yeah, we think so too. Now they're probably going to say, well, we guess end of 2022, maybe end of 23. Oh, we say 24. They may not agree on exactly when. That's not what you and I need to know. What you and I need to know is what happened in 2000 and 2008 doesn't need to happen to us, because we can do two major things to protect ourselves. I like Josh's comment. I hadn't commented on it. I'm going to talk about those two things. We're about 300 points away from a 20% correction and entering a bear market officially. So there you see it. A bear market officially called by Wall Street is when we're closing in 20% or lower, really lower than 20% from the high. Okay, from the high. And Josh is no doubt referring to the S&P 500. I've been telling students for a month and a half, 2 months now. You know, the S&P 500 is a nice, there's so much to say. It's a nice index of 11 sectors of our economy, right? It's a broad-based index is what we call it. It's a great indicator of what's happening across the board. It's not just following tech. It's not just following oil. It's not just following healthcare. It's broad-based. It's following all of those, but it's not equally weighted. It's not equally weighted. Some stocks in the S&P are responsible for more influence over the movement of the index than others. For example, Microsoft is one of the highest weighted stocks in the S&P 500. When Microsoft moves, it has more influence over what we see on this chart that we're looking at. Of course, we're looking at Amazon here, so let's go back to the S&P 500. It has more influence over that. So what I would say is, as we're moving forward, if we continue to see weak tech stocks, remember in COVID recovery, tech stocks went absolutely bananas, hysterical, right? Warren Buffett just did his shareholders meeting. Very big event. They streamed it live on the internet. Everybody wants to hear what the Oracle of Omaha has to say. And he just talked about the markets are in this place of absolute hysteria with their buying. It's untethered from the fundamental value of companies, and speculation has taken over. And that's about the time we start to see a lot of danger for long-term buy and hold investing. That's where we start to see danger in our trading, because things start to become more money begins to shift from one industry sector to another. In this case, tech. This is why I'm saying this. Tech has been really, really weak, and that has caused these indexes to be really, really weak. So we need to watch that in the future. I want to tell you these two things that you ought to know about when we're coming into a recession. Now, I did mention, as Josh has said, I think it's just good input, when we're looking at an actual recession in the stock market, right? An actual bear market, 20% is really that line in the sand that we're looking for, okay? 20% is really the line in the sand that we're looking for. I'm actually going to pull this up really quick. I'm going to show you guys another chart. Unfortunately, it just automatically logged me into the wrong one. You know what? This is interesting though, guys. This is not part of my notes, but hey, look at this. Apple just pops up on here. I just kind of want to pop this in. Just kind of got this nice channel going on Apple right here. Be very interested to see what happens with that. That is not what I was going to show you guys today. What I was going to show you is just the line in the sand on the S&P. But like Josh said, about 300 points away. You're at 4155, okay? So we'd have to go a little bit further down here, but just about down here, okay? We're looking at, when you look at this chart, that's not a lot of movement to the downside. In fact, from the lows of today, we were pretty darn close to that. So what do we need to talk about here at this point? Okay, Blair. So there are some real factors that are suggesting that we're moving at the very least into a much different season. We were in a raging bull market. That's not the case anymore. At best, this is an old, tired, ready to lie down and die bull market, okay? We're not there yet, but it's definitely changed. At worst, we're on track for a much bigger recession than they even forecasted. And that is what a lot of experts are saying right now. And those factors are really driving that tech sell-off, that higher inflation, that unemployment, the raising of those interest rates. The war in Ukraine is having somewhat of an impact on that, although I don't think, as I said already, it's as pronounced as some people would like to say it is. My opinion is that they take that off of the administration, which I think is highly accountable for the place that we find ourselves in right now. But I digress. What do we need to do now? First of all, we need to learn to protect what we have. One of the biggest things, whether you're investing or you're trading, I meet people on the weekend. I've experienced this in my trading. It's not what you make, it's what you keep. It's not what you make, it's what you keep, right? We don't want to give back all of our gains if we go into a recession. The typical approach, not by all, but by many financial advisors, is that we ought to just ride the markets all the way down. We don't believe that here at Tradeway. We do not believe that you just ride the markets all the way down. There are ways that you and I reasonably can protect capital, whether we are moving our stock exposure into less risky assets, maybe even moving them to cash at the right time, or just using hedging strategies. You know, options originally were designed as insurance contracts. That's why options were originally designed, right? Did you know that a put option makes money when a stock goes down? Now, here at Tradeway, we like to just buy and sell the put option. We're not even hedging. We just like to buy and sell the put option because we can make money when we do that when the stocks move down. But initially, the idea was that I own stock, I buy the put option, and if my stock goes down, which I'd like to hold, I don't want to sell, then I can buy an insurance contract, in this case, a put option, and I can actually make money on the put while the stock is going down, and I can stand to protect that stock. Yeah, I have to pay some premium on that contract, but it's a small percentage of the value of the stock. Okay. There's a lot more to say about that as a hedging strategy. When does it work? How does it work? Does it work the way we want it to? But that's originally what they were designed to do. And the point is that Wall Street knows how to protect, right? I promise you, Wall Street does not just leave their money in all the way down. They are active managers. They move it around. In long-term buy and hold, we don't want to be overly active. That's a trading mindset, not a long-term buy and hold mindset. But here at Tradeway, we do want to equip you to know, where's this market at? What are the risks we're looking at? What are we doing with long-term money over here at Tradeway? We actually manage a fund for Tradeway students that is in the markets long-term. That is something that we do every day. So that is something I want you to be aware of. How am I going to protect my money? I'm going to tell you something practical for you and your financial advisor. One of the most important questions I can give anybody to ask your financial advisor, who, by the way, may be awesome. Maybe he or she is doing a phenomenal job. I have a lot to say about mutual funds and returns and how Wall Street passes on some of the returns to you and all of the risks. It seems kind of unfair that we would take on all the risk and only get a portion of the profits. They think because they're managing them that they get that much more out of it. But hey, maybe if you and I bought an S&P index fund last year, it returned 25%. If you and I owned it, what would we get? We would get 25%. It's not that hard to buy. A lot of people are moving out of mutual funds and into ETFs. You say, Blair, I have no idea what you're talking about, but it sounds really cool. Step one, start your journey, right? That's what we'll be talking about in step one, start your journey. If you're brand new and you don't know any of this, but you say, you know what, Blair, I want to protect my money. I got to protect my money. Even if you're just starting out, hey, let's keep it going, right? We don't want to risk more than we have to risk. It's not what you make, it's what you keep, right? You can go and check out tradeway.com, step one, start your journey, and we'll get into that. But the point is, we've got to protect, right? We've got to protect what we have. The second thing I would say is that recessions provide opportunity. I've heard it said, if somebody out there has data on this, you can certainly chime in. I've heard it said, in fact, I'm going to put this up too. Josh put another comment in there. I'm excited to learn about inverse opportunities, learn to trade those as well. You know, prices reset in recessions, right? Stocks get cheaper in recessions. Now, some companies fall out of favor and never recover, which, by the way, is worth talking about when you and I are told, leave it in all the way down, it'll come back. I would say two things to that. One, some companies, no. Some companies will not come back. Okay, we don't know which ones. But number two, why would you have that opportunity cost? And if you're like my friends in the stories I told earlier, you might already be in your late 40s, 50s, or later. You don't have time to wait 10 plus years for the market to come back, right? So that's not a viable option. By the way, I didn't get to what's the number one question I would ask your financial advisor? What's your plan for me in a bear market? What's your plan for me in a bear market? That would be the question, right? I would like to know what you're going to do, and I would like to know how you're going to contact me and tell me what my options are in a bear market. And if they say we're leaving it in all the way down because you can't time the market, just know that us here at Tradeway, we don't agree with that. We know that's a common answer. We actually don't agree. We actually don't agree. We don't claim to be able to time the exact top and bottom of the market. Sometimes that's the counter argument. Well, anybody who says they can time the top and the bottom is just lying to you. Well, I would agree with that. It's very, very difficult to time the exact top and bottom. But in major recessions, we don't need to time the very top and bottom to be a good steward and protector of the assets that we have and that which we've made in the bull market that we've just come through. Okay, so that said, I will move on. What about growth? What about the opportunities, right? I was going to say, somebody may have, I didn't look this up because this is just something that's coming to mind at this moment, but I've heard people say that more millionaires are made in recessions than at any other time. I don't know if that's actually true. I'm not going to make that as a statement of fact, but I certainly can see how it could be true. Because for people who protect themselves, for people who have skill sets, for people who know, I said already, I am not a real estate investing expert, but I am around real estate investing experts. And looking for the opportunities, even in real estate and property, when things undergo a massive reset, is a massive opportunity for them. For you and I, it's a massive opportunity on Wall Street. 2020, when everybody was thinking, oh my goodness, Wall Street's going to zero, these companies are all going to disappear. Well, actually, that was a lot of really great companies at a massive discount. And look what we saw happen. Let me show you a little bit more. We go a little bit further back. I'm going to go to the 3-year chart here, just so you can see this drop here. Okay, so here we are, right? March, okay? And then we move up just a couple of months later, I should say even over here, right? Into the fall, we're back to those same levels right here. Okay, now that doesn't mean every single company, example, let's go over to, say, American Airlines, right? Oh, nobody's flying anymore. Look at this. Boom. It just got killed, right? And then in not that long of a time, it doesn't get up to pre-COVID levels, but it makes a pretty big high. Then it comes into here, which, by the way, came right into that gap level, which is something we teach on extensively. Watch out for those gap levels. That's what it did. It tested that high twice, and then it dropped again. It's not unreasonable to say that a student who had a long-term position on this because they took advantage of it when it was so cheap in COVID, we actually teach a strategy here where you can buy stocks like this at a discount. You can get paid to buy stock in the stock market if you know how to do it. You can get paid to sell your stock in the stock market if you know how to do it. It's actually not even that hard. And if you have a brokerage account, chances are you already have privileges approved to do it. You just don't know what it is. You just don't know what it is. It's called a covered call or a cash secured put. We are going to talk about options in Step 1 Start Your Journey. So if you don't know any of that, you got to get to that class. I'm telling you, it's going to cost you less than $100 to learn what I'm telling you right now. That doesn't even, the math is crazy. You got to do it. The only thing is an investment of time and trust in us. If you haven't done it yet, you got to do it. I'll be on there. Dave Huber will be on there. It's at tradeway.com, right on the main page, live events. You can sign up. You got to be there. Okay. That said, discount. A lot of stocks are on a discount. Now, I'm not just saying, hey, once we get into a bear market, let's just go out there and buy everything. Obviously, we do need to learn a skill set. I just mentioned Step 1 Start Your Journey. I want to give you a skill set, but I am saying that in those times, there are tremendous growth opportunities, right? There are tremendous growth opportunities, and I don't want to give all my money back so that I don't have any to take advantage of those opportunities, right? That's something I don't want. That's something I don't want. I just feel like this is something we're saying today. I had a good friend of mine reach out and just say, you know what? I just paid off all my debt. He was just celebrating, praising God. You know, they'd had some really difficult family struggles, health struggles at one point several years ago. They ended up in a financial position that they never planned on being in. And they were able to get completely free and clear of debt. And you know what? I just thought, hey, that's an amazing thing. Obviously, at Tradeway, we use debt in different ways. We don't believe it's always bad. We believe there are plenty of bad kinds of debt, high interest credit card debt, buying toys, not cash producing assets. That's not a good kind of debt, but debt happens. Getting out of that, getting my house in order as I'm moving into uncertain economic times. These are good things to have on the radar as we are moving into these times. Saying, you know what, I'm not just going to learn to make money. I'm going to learn to make money with my money. I'm going to learn to protect my money. It's not just what you make, it's what you keep. It's not what you know that makes you money, it's what you do with what you know that makes you money. And that's what we want to help you do so that you can not only survive, but thrive in any season. 20% down from the high, official bear market. Are we going to get there tomorrow? I doubt it, but we are certainly seeing those headwinds. Remember, that Fed meeting is on Wednesday, 1 p.m. Central Standard Time. I expect we'll see some short-term volatility in the markets right away. Sometimes it shakes out pretty quick, but we'll probably see that boom, little explosion on those minute charts as we see that news come out. Expected to raise rates. If they don't, that'll be pretty surprising. We'll see how the market responds to that. I can't imagine they won't. They're expected almost unanimously to do so. I expect that they will. Perhaps they raise rates a little more aggressively than we expect. Or even yet, they make a statement that says, we need to raise rates even more in the future this year than Wall Street originally thought. If that's the case, remember, raising rates is meant to cool the economy. Now, they don't want to kill the economy, and that's the balancing act. It's very difficult. They have to cool it, but not kill it. And right now, we're seeing that headwind. So you and I need to have our eyes open, need to be prepared, heading on over tradeway.com right here, online virtual events. Scroll right to the bottom of that page, and you'll see join coaches Blair Nightingale, Dave Huber Sr. on our next step one, start your journey live. Boom, click here to register, and you can join me for the broadcast. Thank you guys so much for being with us. We went a little bit longer tonight. Super, super important. Remember, we can protect, we can promote. We have to be ready. We want to respond, not react. If somebody else out there that you know needs to hear what we talked about tonight, make sure Facebook friends tag their name in the comments, send it on over to them. If you're on YouTube, you can send them the link, ring the bell, click the like. We'll let you know whenever we're doing anything here on Facebook. I appreciate you guys. I always say on here in closing, if you got anything you want to ask, send it over to support@tradeway.com. and they'll get that over to me. Somebody sent in an email this week, had a request for a specific episode, and I'm going to do an episode in the future based on one of our viewers' requests. So if you send that in, I will cover that in the questions. I may even do an entire episode about it. If you want, I will give you a shout out. I won't do it unless you tell me that it's okay to do so. But I'm happy to hear from you guys. This isn't just something that we get to watch. This is a way that we get to interact. So I appreciate you guys. Ken, I see you there. Good evening to you. Josh, thanks for chiming in, commenting, and being on the journey with us. I invite everybody else out there, if you don't trade, you got to learn how to trade. You got to learn how to protect and promote your capital. Our friend Myron Golden says, the reason you and I have a JOB is because our money's unemployed. And the more our money's unemployed, the more freedom we can have. This is one of those ways. This is how the wealthy do it, and this is how we can learn together. Thank you guys for being on tonight. I'm going to shut down the charts. Say goodnight. I will see you next time. Good night.